Accounting, it's like that thing you avoid. Let's be honest, accounting isn't exactly known for being a laugh riot. It's often the subject that people dread, the one that makes you want to do anything else but deal with it. It's often seen as that dry, complex subject that makes your eyes glaze over faster than a Krispy Kreme donut. The numbers, the jargon, the endless spreadsheets, it can all feel overwhelming. But here's the thing. Accounting is actually the backbone of the financial world. Without it, businesses would be lost, unable to track their performance or plan for the future. It's how we keep track of money, and in a world obsessed with money, that's kind of a big deal. Every transaction, every financial decision, it all comes back to accounting. Think of it like this. You wouldn't eat soup with a fork, would you? Okay, bad example. Some of you rebels probably would. But seriously, using the wrong tool for the job just makes things harder. The point is, you need the right tools for the job. And in accounting, those tools are the standards and principles that guide how financial information is recorded and reported. And in the world of finance, those tools are accounting standards. They ensure consistency, reliability, and transparency in financial reporting. We're talking about the rules companies use to record, report, and show off their financial goodies, or sometimes not so goodies. These rules help investors, regulators, and other stakeholders make informed decisions. And in this corner, wearing the internationally recognized trunks, we have IFRS. The International Financial Reporting Standards are used by companies around the world to ensure their financial statements are comparable and understandable. And in the other corner, sporting the stars and stripes, it's GAAP. The generally accepted accounting principles are the standard in the United States, providing a framework for financial reporting that is trusted and relied upon. While IFRS and GAAP have their differences, both aim to provide a clear and accurate picture of a company's financial health. Understanding these standards is crucial for anyone involved in the financial world. So next time you think about avoiding accounting, remember that it's not just about numbers. It's about telling the financial story of a business, and that's something worth paying attention to. First up, let's meet the international contender IFRS, which stands for International Financial Reporting Standards. Don't worry, there won't be a quiz later. Just picture IFRS as the United Nations of Accounting, with over 140 countries following its lead. It's basically the cool kid on the block, except for that one kid, looking at you, USA, who insists on doing their own thing. The goal of IFRS is to make financial statements easy to compare, no matter where a company sets up shop. It's all about making things clear and consistent, like a universally understood thumbs up. Except instead of thumbs, it's numbers. And instead of being simple, it's often really complicated. In the other corner, waving the American flag and refusing to use the metric system, we have GAAP, or Generally Accepted Accounting Principles. GAAP is like that friend who loves rules and follows them to a T, even if those rules involve alphabetizing their spice rack. Hey, no judgment. GAAP is the accounting standard for the US, and it's known for being very rule-oriented. Think of it as a detailed instruction manual, whereas IFRS is more like a choose-your-own-adventure book. Both can get you to the end goal, understanding a company's finances, but they take different routes. One of the key differences between IFRS and GAAP is how they handle inventory. Inventory is just a fancy word for all the stuff a company has sitting around waiting to be sold. Think mountains of sneakers, barrels of crude oil, or rooms full of rubber chickens. Hey, you never know what people are buying these days. Companies need to decide how to value this inventory for financial reporting. GAAP allows companies to use something called LIFO, last in, first out, to value their inventory. This method can have significant implications for a company's financial statements. Imagine you have a stack of pancakes. With LIFO, you're basically saying that the last pancake you put on top is the first one you eat. Why? Because accounting. This method can affect the cost of goods sold and consequently, the net income. IFRS, on the other hand, prefers the weighted average method, which is like taking all those pancakes, tossing them in a blender and saying, each pancake portion is worth the same. This method smooths out price fluctuations over time. It's all about finding that average pancakey goodness. By using the weighted average method, companies can present a more stable view of their inventory costs, which can be particularly useful in industries with volatile prices. Both methods have their pros and cons. and the choice between LIFO and weighted average can significantly impact a company's financial health and tax liabilities. Understanding these differences is crucial for investors, analysts, and anyone interested in corporate finance. So next time you see a financial report, remember the pancake analogy. It might just make those numbers a bit more digestible. Section 5. Cash flow statements. Where'd all the money go? This section is crucial for understanding the financial health of any business. Another key difference is how IFRS and GAAP deal with cash flow statements. These two accounting standards have unique ways of presenting financial information. Think of a cash flow statement as a company's financial diary, detailing where all the money came from and where it all went. It's like a detailed journal that tracks every penny. Was it a wild night out on the town or a sensible night in with a budget spreadsheet? The cash flow statement will reveal whether the company splurged or saved. The cash flow statement knows all. It provides a transparent view of the company's financial activities, showing how well it manages its cash. IFRS and GAAP have different rules for classifying things like interest and dividends, those lovely payments you get for owning stock on the cash flow statement. Under IFRS, interest and dividends received can be classified as either operating or investing activities, while GAAP typically classifies them as operating activities. It's a bit like arguing whether pineapple belongs on pizza. Both sides have their reasons, but it mostly just leads to heated debates and the potential for thrown pepperoni. In the end, the classification can significantly impact how a company's financial health is perceived. Section 6. Balance sheet posing. Striking a financial figure. Finally, let's talk about the balance sheet, which is basically a snapshot of what a company owns, assets, and what it owes, liabilities, at a specific point in time. Think of it as a company's financial selfie. It can be flattering or not, depending on the lighting and what they're hiding off screen. GAAP and IFRS have different rules for how things are presented on the balance sheet. It's like deciding whether to organize your bookshelf alphabetically, by genre, or by the highly suspect method of books I haven't spilled coffee on yet. Section 7. The impact when numbers look different. Gasp! So, why do these differences matter? Well, imagine trying to compare two companies, one that uses GAAP and one that uses IFRS. It's like trying to compare apples and, well, other apples, but these apples were grown on different planets and one of them sings show tunes. The point is, these differences can make it tricky to compare companies directly. It's like trying to judge a staring contest when one person is wearing sunglasses. You might think they're losing, but they could be winning by a mile. Section 8. Convergence. Can't we all just get along? The good news is that there are efforts to bring IFRS and GAAP closer together. It's like trying to get cats and dogs to be friends. It might take a while, and there may be some hissing and barking along the way, but ultimately, everyone just wants to live in a world with fewer accounting discrepancies. Section 9. So, who wins this accounting cage match? So, which accounting standard is better? The answer, as with most things in life, is it depends. Both IFRS and GAAP have their pros and cons. It's like choosing between a vacation in a bustling city or on a relaxing beach. Both can be great, but it all comes down to personal preference and what you're looking for in an accounting standard, or a vacation, I guess. Section 10. Ready to dive deeper? Don't worry, we'll bring Floaties. And there you have it, a crash course on the wild world of IFRS and GAAP. If you're still with us after all that accounting talk, congratulations. You've officially earned yourself a gold star. Disclaimer: gold star not redeemable for cash, prizes, or a free pass on your next accounting exam. But hey, you've taken the first step towards financial literacy, and that's something to be proud of. Now go forth and impress your friends with your newfound accounting knowledge.